is focused on modeling stock market distributions and, in particular, looking at their kurtosis. So, traditional investment strategies have long been based on the assumption that market returns follow a normal distribution. Two examples of this are the Black-Scholes and the CAPM models, both of which utilize this assumption, but it turns out that in reality, market returns might actually exhibit fatter tails than a typical normal distribution has, and so having a better understanding of the true distribution of market returns can be really important when it comes to evaluating risk and making investment decisions based on these calculated risks.
So our goal with this project is really to use Gibbs sampling and JAGs to understand our hypothesis that market returns follow a normal distribution versus a distribution with a fatter tail. So we might expect the fatter tail distribution to fit our data better, but that will be the goal of our project. We're going to study three distributions that have fatter tails, those being the double exponential, logistic, and student t distributions.
And so the data we use for this project we obtained from the FRED database. We're specifically looking at daily returns for the S&P 500. So after removing holidays, weekends, any non-trading days, we calculated the daily returns using this formula on the slide. And it's the distribution of these returns that we're interested in.
So just to recap, we're going to first run JAGs on a normal distribution to figure out how well the data fits that distribution, and then we're going to run it 3 more times on the distributions I said before to figure out how well the data fits those distributions, and we'll run posterior predictive checks on all to see how those 3 distributions compare to the normal. And then at the end, we'll figure out what distribution fit the best, and then we're going to run a regression model with that distribution to see if interest rates are an important factor modeling stock market returns.